Hey everybody, I hope everyone's doing well and had a good day. This is the overview of the Emini 5-minute chart for Thursday, October 31st, 2024. Today was the last day of the month. And you can see the month closed a bear bar. And if we go back, here's the start of the year. This is only the second bear bar on the monthly chart of the year, and the first bear bar in 5 bars or 6 bars. Now the problem for the bulls up here, I've been talking about it. The main thing, the trader's equation. Here's a huge bull bar. If you buy above this bar, there's August. If you buy on a stop above August, stop below the bar is big and the risk is far. So going for 1 times your risk is really far away. And it might be a late leg. We have a buy climax, pull back, buy climax, pull back. We started going sideways up here. And it's sort of an unrealistic target. If you're buying here, you really need momentum. And we pulled back on this bar, and we're starting to go more sideways here. We're far above the moving average on the monthly chart. We may have to pull back to find buyers, but this is one of those bars that I think a lot of traders will get out below. It's sort of a GTFO bar. It's one of those default exits that Al talks about. We're in a rally, but consecutive buy climaxes far above the moving average. The risk is big, climactic. You get a bear bar closing on its low. Usually better to just get out and see what you get and maybe look to buy again lower after some kind of pullback. But you just don't know how far this will pull back. And maybe the market is in a trading range since down here, and we could test all the way down here. And it may be gradual. We may drift sideways to down, and maybe an endless pullback, maybe a trendline break, retest, and then reverse. But whatever happens, I think a lot of traders get out below this bar. Daily chart. The market had been in a tight trading range here. 3 pushes up. Tight trading range, possible final flag, bull breakout, bad follow through, another tight trading range. Limit order market through here. Any trader who bought below yesterday or any of these bars, even here, they're getting trapped today. I've been mentioning that this tight trading range, the possible final flag, the midpoint of that trading range is a magnet, and the market would likely go back and test somewhere down there. But going into the day, I figured buyers below the bar, sellers above the bar, and that the tight trading range and limit order market would continue. But the fact that it's the end of the month can change that. The market often tries to change the appearance of the bar at the end of an important bar. So in this case, it was the monthly chart bar. But that's why Fridays you typically get a trend day. It influences the weekly chart bar. Or you'll often get moves in the final couple hours of the day, and that influences the daily chart bar appearance. On the 5-minute chart today, we had a gap down. The gap wasn't all that big in terms of percentages. It was about 0.75% down. It's fairly big, but not huge. But the gap looked huge because we've had so many days with small daily ranges, lots of overlap, and then suddenly we got this bear breakout. The odds were we'd get a continuation in the direction of the breakout. You can think of the gap down as simply a breakout. On the open, we had a bear bar. Tail below the bar, suspicious for the bears, but followed through after the gap down, good for the bears. And then an II pattern, so consecutive inside bars. The market is contracting here. It's a triangle on a smaller time frame. We're getting higher lows and lower highs. It's breakout mode. And after the gap down, the breakout direction has a bearish bias. And because it's an II pattern and a small bar on 3, typically the market comes back and tests the apex of triangles. And there's tons of examples over the past few days you could look at. But here, bar 4, big bear breakout. It's a surprising bar. It's a really strong bar, opening basically, at least on TradeStation's data here, opening on its high and basically closing on its low. Really strong bear bar. Also, look at the overlap with bar 3. There's virtually no overlap. Any trader who bought below bar 3 is trapped. Anyone who didn't sell, also trapped. And we went down several times the range of bar 3. So this is a fairly big breakout. The odds are it's going to get a second leg down. Now you can see what happened on bar 5 and 6. After big bars like bar 4, typically the market goes sideways for 1 to 3 bars. And you can see that all over the place. Bar 4, big climactic bar, sideways for 3 bars. Bar 10, trend bar, sideways for a bar. 12, trend bar, sideways for 3 bars. And you see it all the time. We pulled back on 5 and 6 and we tested the breakout point of bar 1. We could not quite get there. So any trader who bought below 1, they were not able to exit at their original entry price if they bought the low. You can see bar 6 did not reach it. Any trader trying to sell at the low of bar 1, the breakout point from the bar 4 breakout, also unable to get filled on their limit order to go short. So we're trapped traders here. We have an open gap. The body gap is big. So we have the gap down, another gap from the bull bodies here. And I believe there was even a body gap in here. Very small, but important. There's a gap on the line chart. The line chart plots the closes of bars. So really it's from the close of bar 4 to the close of bar 10. So early in the day, we had a couple of open gaps. And just think about it. How easy is it for a bull to make money in the first hour up to bar 12? It's pretty difficult. Maybe if you bought below 5 and scaled in, you could have made money, but not ideal. Much easier to make money selling. So we have a breakout, sideways, implied pullback, another breakout, pullback, another breakout, pullback. That's 3 pushes down, but the channel down is tight. It's a parabolic wedge, but parabolic wedges are minor. It's a wedge on a smaller time frame, but on a higher time frame, this is simply a bear breakout. So you can expect the reversal to be a minor reversal, and then for this entire breakout to get a second leg down. It can really help to look at a higher time frame chart. In the top right of my screen, I have the 15-minute. So up through bar 9, that's the first 3 bars on the 15-minute chart. So that's up to here. So fairly strong breakout, probably going at least a little bit lower and probably getting a second leg down. Bar 10, we have a bull bar, but a bad signal bar. The stop order above 9 is the signal bar. Triggered stop orders above 9. But 10, a bull bar, but tail and bad context, probably more sellers above, and then bad follow through for the bulls on 11. And any bull who bought for any reason, maybe they bought here or here, anywhere, 12 is a give up bar. The bulls are not making money. They need momentum after bar 10. Ideally, bar 10 doesn't have a tail, but it did have a tail, and then there's no follow through 11, so traders give up. They bail out of the trade. Bulls sell out of longs, and bears sell to get short because this is a breakout on a higher time frame and should go lower. So 12, a new breakout, you can expect sideways and then another leg down, and that's what we got. Traders looks like they sold with limit orders at the low of bar 10. That's a breakout point. The bar 9 low is another breakout point. Traders are selling here and here, getting filled on 13, catching a second leg down. 14 through really all the way down. It's a micro channel. Should get a second leg. 16 a little climactic. It's easy to think this is a bear trend that can last all day, but in reality, the sell-off has problems. And the problems, one big problem is that these are climactic breakouts. This is not how small pullback trends that last all day behave. You're getting a sell climax, a pullback, sell climax, pullback, sell climax, over and over. These are consecutive sell climaxes, far below the average price. Small pullback trends are more orderly, and the bars are smaller. The pullbacks are smaller, not as deep. And the problem with sell climaxes is that it shakes swing traders out of their trades. Climaxes can be seen as gift bars. If you imagine that you're a bear, you get a huge bar, you're probably going to take profits and then look to sell again on a pullback. But once you get enough consecutive sell climaxes, the bears are exhausted and they're going to stop selling and start looking to sell pullbacks after 2 legs and maybe 10 bars. So that becomes the problem down here. We get a tight trading range, lots of bars overlapping each other. And bar 22, that's an always in sort of flip where the market didn't necessarily go always in long, but I do believe always in bears need to exit shorts above bar 22. If they do, they can sell again below 24, but then it's the same problem with bar 30. And certainly bears get out above bar 30. The risk is we get a pullback to the moving average. Bears would rather sell the pullback. If traders know the market's going higher, bears are not going to hold shorts and bulls are not going to sell out of their longs. Sort of a nested spike and channel all the way down, really, and it evolved into a spike and channel day. You can see the gap down is a breakout, bar 4, a breakout. We pull back, we start to channel, but each breakout is resetting the market cycle. That's why it's tough. You don't want to count legs in the direction of the major trend because you'll inevitably call bar 9 a wedge bottom and buy somewhere in here expecting some kind of reversal, maybe 10 bars and 2 legs, or worse, a major reversal. But in reality, it's simply a breakout on a higher time frame. That's the danger with counting legs with trend. But down here, a lot more overlap. We've had a lot of consecutive sell climaxes. Bears are probably getting out here. And if they do sell again, they're getting out here. What happened through here? This is a breakout and a low 1 short on a higher time frame chart. And low 1s typically pull back deeper. The low 1 typically fails and then the market pulls back deeper and you get a low 2. So the low 1 short on the higher time frame might be below bar 24, somewhere in this area, but the expectation is buyers below, deeper pullback, and that's what we got. And what I'm talking about, you can actually see on the 15-minute chart. We got a pullback. This bull bar went above the prior bear bar, and that becomes the low 1 signal. Doesn't trigger, but this inside doji bar becomes the low 1 signal. We trigger the sell, but why do low 1s fail? You think about traders who, let's go back and think through, selling the low tick of bar 20. Some unfortunate bear sold the low tick down here, and then they got this 2-legged pullback. The market went fairly far against them. If you sold here, the market pulled back all the way up here. That's disappointing. So what's a bear going to do who sold here and sat through this deep pullback when the market retests their entry price? They're going to buy back shorts. Bulls know that and they're going to buy. The bulls know that 22 and 23 should get a second leg up, and maybe that happened on 25, but also more bulls will rather buy below that breakout or buy below the swing low, and that's what we got. And that's the low 1 on the higher time frame chart, and it pulled back into a low 2. This is a big low too, but on this chart, I'm going to try to explain this in a not so confusing way. Technically on this chart, you can say bar 35 is a low 1. This is a micro channel up, low 1 short, first reversal. However, it's also a higher high double top, and every double top is a low 2. Low 124, low 2, 35. You can also call it a low 2 if you count implied pullbacks. Rally on 30, pause, and then rally up to 35, low 2. You can even call it a low 3, a couple of different ways. Rally, pullback, rally, pullback, rally. That's 3 pushes up and a reversal below 35. Also 3 pushes here. 17, 23, 35. The problem with selling here is the channel, or the rally is too tight. It's a channel on a smaller time frame, but on this time frame we have a breakout. It's really a spike, no pullbacks, and that's probably going to get a second leg up. So we have a minor reversal and then get a second leg up, and that second leg subdivided into 2 or 3 legs of its own. We rallied on 36, pulled back, rallied up to 40, pulled back, rallied up to 45. In this area, 45 is a problem for the bulls. And let me back up. 40 is also a problem. And I think traders will exit longs below bar 40 if it triggers. Maybe they do during 42. But I think certainly below 45, bulls need to exit longs. Market's briefly always in short through here, but the overall context is more bearish. Most bars today are completely below the moving average, and we're evolving into a trading range, but it also could be a bear channel with a high here and lower highs here and a low and a lower low. And that's what we got. So this is a fairly broad bear channel. Stop order bulls able to make money. You basically trade a broad channel the same way you trade a trading range. You buy low, you sell high, and it's okay to swing to the downside when it's a broad channel, but usually better to scalp if you're buying, and really only better to buy in the lower third. So there's a low 3 short below 45, and it's a lower high. You can call it a double top, but a reasonable area for bears to look to go short. And then 48, if bulls are not out below 45, they certainly exit below 48, and we get another sell-off. But this time, same logic as over here, disappointed bears buying back shorts. Think about the bear who sold the close of bar 29. If you sell the close 29, market rallied against you for 5 bars, and it's a really deep pullback. So what are bears going to do back at this price? They're probably going to buy back shorts. Now, are you eager to sell at the low of the day over here when we get back here after seeing this? Probably not. This looks like a trading range at this point. We have a high, higher high, higher high. Might be an expanding triangle. Couple pushes down, 3 pushes up. That's 5 legs, and it's expanding. And the point is, there's probably buyers down here. So there's a swing sell up here, but look at the breakout. Decent bear bar, but the follow through isn't great. 50 overlaps, 49 a lot. Same with 51. We start going more sideways right at the low close of 29. And if you're selling and you're at the bottom of what could be a bear channel or a trading range, you need momentum. And if you lose momentum, you lose your high probability. And if you lose your high probability, you cannot be selling at the bottom of a channel. So bears buy back shorts, and bulls begin to buy. We start going sideways through here, and finally we got the bull breakout. But the bull breakout has problems, and it's important to understand the problems with this breakout. There's problems with the characteristics of the breakout itself, and there's problems with the context that it's occurring in. So first, look at the breakout itself. Bar 65 was an inside bar, and most inside bars get retested within a few bars. 66 crossed the moving average, but about half the bar is below the EMA, and there's a tail above the bar. 67, a small bar with a small body, did not close above the prior bar, sellers into the close, lots of overlap with the prior bar. And then bar 68, a little bit climactic, a stronger bar after some not so great bars, but still tail above. That's a little climactic and will attract profit taking from any bull who bought lower. Now this is strong enough for a second leg, but that doesn't mean this is a bull trend. The bulls are hoping we had a bear trend line break. Let me get rid of this channel line and I'll put it back. Tight bear channel, bear trend line break, retest of the trend's extreme. Bulls hoping for, in this case, a lower low, major trend reversal. But a couple problems with that. The first thing, it's stronger when the trend line break is more up and the bulls get some bars completely above the moving average. In this case, the trend line break was more sideways and the bulls only got one bar completely above the moving average here. Also, with any major trend reversal setup, the most likely outcome is the trading range. Most of the time, reversals fail and the market instead goes sideways. Sometimes you'll get trend resumption, and then, of course, sometimes you get the reversal. But 60% of the time, you get a trading range, and that's what we got here. So the bulls buying here, hoping for that major trend reversal. Bear trend line break, retest, look to buy, and go for the reversal. So we talked about the characteristics of that bull breakout. And let's talk about the context. High, lower high, and up to this point, lower high. And what do bears do with rallies in a bear channel? Bears sell rallies in bear channels. Just look at any rally today, any bull bar, or any pair of bull bars, or consecutive bull bars. They did not get good follow through, or they reversed immediately. So here, getting bad follow through, and then reversing. Now again, this should get a second leg up. It's enough of a surprise for a second leg. And we're testing this breakout point down here. We're coming close to the bar 65 high, the inside bar. So buyers in this area for a second leg, deep pullback. Traders aren't going to buy and hold up here if the momentum dissipates, because this is not a bull trend. This is a rally in a bear channel. So you can buy up here if the momentum is good and strong, but if the momentum disappears, your high probability disappears, and you cannot be buying up here unless you're quick to get out and you need a tight stop or a quick exit, because the last thing you want to do is get stopped out below bar 66 or 65 or at the low of the day, because it's more likely that there are buyers down here. The bulls get their second leg, but this sell-off was strong enough for its own second leg down, and the market's likely in a trading range at this point because we're going above a major lower high here. And you can even argue that this is not a major lower high because we did not get a strong breakout to a new low, although we did go to a new low. But the most recent major lower high might be bar 13 or even up here. But for the sake of argument, let's say bar 45 is a major lower high. We broke above it and immediately found sellers because this is likely the top or near the top of a trading range. So what does that mean? What are bears going to do? What are traders going to do at a new low of the day? Same problem with over here and here. Are you eager to sell at the low of the day? After seeing this rally and all this overlap? Probably not. There's more traders likely buying down here betting on a failed breakout. And 78, we're attempting to break out, but still need one more bar for the bears because this is truly the breakout bar. 77 is within the trading range. 78 is breaking out of the trading range, but then no follow through. I didn't do much today. The one trade I took, I sold below 45, basically taking a chance. I had two thoughts with that trade. And my initial thought was I would exit at the bar 29 close. I figured this rally was enough to disappoint bears who sold down here, and we might be in a trading range at this point. However, because of the sell-off on the open and the sideways trendline break, I thought trend resumption was possible, and we might get sort of a leg one pullback, leg two. The problem with that, I wasn't sure if that was enough of a correction. And this might all be one leg on a higher time frame, and in this case, it sort of was leg one, pullback, leg two, and then an attempt at trend resumption. But I sold here, and I was watching very closely through here. I didn't like seeing the overlap and the bars getting smaller here. I know that I'm holding a short at what could be the bottom of a trading range at this point. When I saw bar 52, I ended up exiting, I think below 53 or on the close of 53, somewhere right in here. I was flat before the close of 54. I remember that. And I didn't do anything else for the end of the day. I had to leave somewhere in here. I saw up to about bar 68, 69, and I figured the tails above, this is a parabolic wedge on a smaller time frame. These tails indicate pullbacks. Traders are taking profits. They're selling into the close of the bar. Strong breakouts, strong bull breakouts close on their high or near their high. But here we're rallying, pulling back, rally, pull back, climactic bar. And the context was high in a channel. So I thought, while this would probably get a second leg, the upside would likely be limited. And this was more of a sell zone up here. For stop orders, some traders will sell below 3, taking a chance that we get 4. Others, you wait for the low 1 below bar. Really, you could sell below 6. You rallied, pull back, rallied a second time, but higher probability selling below a bear bar, 7. Not a great stop order below bar, 11. Small low 1, inside bar, 14. Some traders will sell, but use a wide stop because that signal bar is small, and oftentimes the market will go above a small bar, running stops, trapping traders out, and then reverse back down. Some traders might buy taking a chance above 22, be a better trade if it closed on its high. But it was an area where always in bears probably get out, and then probably buyers above 30. Through here, maybe if bar 40 triggered, it would have been an okay stop order sell, but it didn't trigger. We had an inside bar in the next bar, and 38, 39 might need a second leg up, but I thought 45 was reasonable to sell. 48 you could sell. Maybe sell to close 49, 50, but you need momentum if you're selling here because of what I mentioned earlier. Then over here, really not ideal for stop orders. It's a tight trading range. Bulls probably exit below 72, so traders might sell. But if you are selling, you're selling after a tight bull channel. And again, it's really a spike on this time frame, micro channel all the way up. And it's probably going to get a second leg. There's a stop order sell on a smaller time frame up here. It's a higher high double top, also a double top over here, and a micro double top. We rallied on 76, sold off, rallied on 77, sold off again. Limit order trades. There's a limit order sell at the bar one low. Didn't quite get there. Traders sold. Traders front ran that sell. Sellers above 9, bad stop order, good limit order. Let me rephrase that. Bad stop order buy above bar 9, so good limit order sell above bar 9. Why is it a bad stop order? Because it's a bear bar, the signal bar is bad, the channel down is tight, and the buying pressure is weak. Probably sellers at the bar 10 low. After the bar 12 breakout, you could sell here or here and get filled over here. And then bar 19 is similar to bar 9. Bad stop order, buy, so reasonable limit order sell. But your entry bar wasn't great, and you're selling after a lot of consecutive sell climaxes. And bar 20 now needs its own second leg. So 21, we have an inside bar, low one short. As far as buying below 20 or 21, it's not ideal, but some traders will. It's an inside bar after consecutive sell climaxes, tight trading range since bar 17, and again 20 needs a second leg up. After this, there's probably buyers below 22 and at the low of the day. 4-bar micro channel, first reversal, probably minor, sellers above 26 for a second leg down. Some traders might have sold above bar 29, but if you did sell above bar 29, you're selling a second leg, and it's a nested second leg, 1 pullback, 2, and the market might be in a trading range at this point, and we might be low in the range. So any bear who sold above bar 29 got trapped on 30. You can see what they did on 31. You sell above this bar, get trapped, use the pullback on 31 to exit your short, and then we rally for another leg. Micro channel, buyers below for a second leg. Traders would typically buy below the last strong bull bar. In this case, 34 is a little small, but maybe 33. So traders buy below 33 for a second leg, filled on 36. Tight trading range through here, buyers below, sellers above. There's a limit order sell on bar 45. It's actually an outside bar, which reduces the probability for stop orders. Outside bars are expanding triangles, and they typically pull back like most breakouts do. So probably better to sell the midpoint of the bar. You can see that's what traders did here. Bad high 1 above 46 and 47, the entry bar for the high 1. Bad high 1 because 3 legs up, nested 3 legs up, top of a trading range or bear channel. So bad context. Limit orders sell above, and on the way down, 52. Probably not a good buy setup after 4 consecutive bear bars, but a little risky to sell above there. But this should get a second leg down, so traders will sell above for that second leg. But through here, limit order market, sellers above bars, buyers below. And then same idea over here. Traders will buy below a strong bull bar, bar 68. They get filled on 73, but disappointing entry bar. And then this was strong enough for a second leg. But if you're selling down here, you're selling in a buy zone after a bull breakout. Let's look at this. We rallied from here to here, pull back about 50%. There's buyers for a second leg. So not great to sell here, but traders will sell up here above the bear breakout with supporting context to the left, high in a trading range or bear channel. And then traders will buy the low of the day, but with this much momentum, they may pull their orders, and that's what happened here. Traders instead bought lower. And then 78, you need one more bar. If you're a bear, you need one more bear bar, and it's a breakout attempt of a trading range. You're probably not going to get the bar. So traders will actually buy that close, buy below the bar, betting that we do this. But that's really aggressive and really too late in the day. Where do we go tomorrow? Pretty decent bear bar on the daily chart. But we spent a lot of time today in a more broad bear channel. But this is a surprising bar. We gapped down and got followed through. Now, the bull argument, bulls will say this is 3 pushes down. 1, 2, 3. Climactic third leg, testing support. So bulls will look to buy in this area. However, the momentum down might be too strong and they may wait for more sideways. So the bears are hoping we get follow through and just sell off below support. But we're entering another trading range right here, and there's probably traders looking to buy at this red line. Bears, really traders, any bear who sold down here got trapped, and they're going to look to exit their losing short back at their entry price. Bulls who missed this rally will look to buy a deep pullback for a second leg. But it looks like we're going more sideways overall. But we'll see. One more thing, the risk right now for the bulls. Overall, this could be, this entire chart could be a trading range. What that means is, while this could be the bottom, this also could be the bottom. And this could also be the bottom. And you just don't know. So if you're buying up here, it can be really dangerous. So bulls might wait. Again, they might wait for the momentum to slow down. But for now, I suspect buyers below this line. All right, thanks everybody for watching, and I hope everyone has a good night.